for the invitation to give this talk. Key question here for me is how to finance the transition to net zero. And the key theoretical debate in the literature is very much focused on this relationship between public and private finance and who's ultimately in best position to lead that structural transformation. And the claim and the argument that I'll be developing here today is that the big green state is much more effective in allocating this capital and also more democratic in achieving a just outcome. So the way I see it, there's kind of two kind of conceptual debates here. And I emphasize the conceptual because I think we do need a strong conceptual foundation to think about the physical cost and the politics of what's going to be happening over the next 20 or 30 years. On the one hand, and what's clearly emerging, and you see it very clearly in Glasgow at COP26, is that big corporate finance is going to lead the charge. And they're arguing that they will mobilize 130 trillion. And I think, as most people here will be aware, global asset managers are very effective in what they do because they finance what's profitable. And they finance what's profitable in the short to medium term. That's ultimately what they're paid to do. They don't finance what is socially necessary. And I think what is socially necessary here in terms of tackling the climate emergency is no less than a complete structural transformation of the economy and the key sectors within the economy. So alternatively, many critics, admittedly myself included, would argue that the financialization of climate and the financialization of nature, ultimately, the financialization of the transition, amounts to, in many ways, corporate greenwashing, privatize the gains and socialize the losses. And the alternative kind of conceptual foundation here is to think about this in terms of the big green state, as I've mentioned, or titled here in this presentation. It would also imply that EU member states would run permanent green fiscal deficits to finance new state-owned renewable energy companies that would compete internationally and globally with the various big companies, as we see in autocratic states further to the east. In effect, what the kind of big green state paradigm would imply is that public authorities, monetary and fiscal, would be coordinating the allocation of capital, not private financiers. And if all of this sounds pretty radical, that's because it is. It breaks with 40 to 50 years of taboo, whereby the allocation of capital has been left to private market actors. But I do think it's also far less radical than hoping that global asset managers and the banks that ultimately manage large parts of these global assets will lead to structural transformation to save the planet. And I also think that the public finance response to COVID clearly shows that this can be structurally done. I mean, it's quite extraordinary how central banks and fiscal policy authorities have effectively coordinated the possibility of governments to raise finance, public finance, to fight a public health emergency. And in my perspective, policymakers ultimately need to develop a similar mindset to solve the climate emergency. And at that, I shall leave it. Thank you very much for taking the time to listen, and I look forward to your questions.
Thanks very much, Aidan. That was fascinating, really kind of big picture stuff. So does anyone have any questions or comments that they'd like to make, either in the room or via the Zoom? But, in amongst all that, I guess the thing that I was interested in was your kind of emphasis on the just transition that other people don't necessarily emphasize, and whether that's been costed specifically and separately to the kind of technical transition, and if so, what your thoughts are on how that might work in capital investment terms. I guess it's a thing that's less easy to envisage the corporate investment in, and may need a bigger push from the public side. Is that fair to say?
Sure. Yeah, I think so very much.
We need to switch to.
Yeah, I think so. I think in the kind of big corporate finance perspective, as I mentioned, the state's role really is to escort them to de-risk their investments, to make sure that ultimately the investments they make are profitable. And the state then ultimately changes behavior by increasing the price of carbon. And the most obvious way to do that is to increase carbon taxes. But I think you can see very clearly at the moment with rising energy costs just how difficult it will be for governments to bring the population and to bring key social groups in society along with them to make this type of transformation. So on the one hand, you can say, look, we're going to make basically burning carbon and driving petrol, diesel fueled cars prohibitively expensive, which in my view is necessary. But that's completely pointless unless you've got free public transport or active travel and high quality public infrastructure that allows people to, ultimately use a bicycle. So the government, from my perspective, should be effectively giving away electric bikes for free, quite frankly. And of course, that requires money. That requires the state taking on and ultimately financing those type of things. And that's the sort of mindset shift that I think would imply the just transition, that it's simply not enough to increase prices and hope that the price signal will change people's behavior. Not even if you do set aside and allocate the taxes that have been raised through carbon taxes to do things like retrofitting houses, etc. But I think, and I would imagine most people here in this room would be very aware of just how much and how big a structural change has to take place, not least in terms of retrofitting people's houses, reducing energy demand, consumption. That can only be done effectively if people can live in relatively warm houses, and that of course costs money to insulate and so forth. So in my mind, that's where the state very much comes in. It's allocating capital to what's socially necessary. But what's socially necessary, for example, building lots of bike lanes, subsidizing electric bikes, somebody will make money along the way, but it's not something that's particularly profitable to big corporate finance in the short to medium term. That's not the type of things that they're thinking about. Whereas I think it's ultimately, that's where the state has to step in and facilitate those behavioral changes by investing in the necessary infrastructure to allow people to do it. So I can't actually hear you, Taz.
Sorry, are we good now? Okay. Sorry, so there was one other that came in from Tamara, which I thought might be helpful for people who are not as familiar with the kind of economic theory. Could you give a quick idiot's guide to what Keynesian economics is?
Yeah.
I think it'd be useful to get a sense of what that implies.
Sure. I mean, like we're all Keynesian in a sense. There's different schools of Keynesian thought, but Keynesian thought basically at its most basic level means that the state and fiscal policy and the government should run a fiscal deficit to invest in key economic projects, for example. So from Keynes' perspective, a Keynesian perspective, a government that's running a budget surplus of 5 or 6% in a context whereby the planet is burning is really a bad problem. That actually the government really ought to be running a deficit to finance those things that the private sector ultimately won't take on. So in a Keynesian perspective, the fiscal policy, that is public finance, the state and ministries of finance work much closer with central banks, monetary authorities, to direct finance and to direct capital to what is ultimately a socially collective good outcome, even if it's not profitable. And it's, an economist would argue that this is about intervening to correct market failures. But from my perspective, it's a lot more than that. It's much more deeply embedded. And that's quite the opposite in a sense of what's happened over the past 30 years, where there's a very clear division of labor. Monetary policy is with the central bank, the European Central Bank in Europe. Fiscal policy is with governments. Governments have fiscal rules. They don't run deficits. They don't ultimately issue debt in order to avoid accumulating too much stock of public debt. But in this perspective, issuing debt, green bonds, let's say, to finance certain types of social investments, well, that's a good thing. That's a positive thing. It's not something that is negative, as would be typically the case in a more ordo-liberal paradigm, which has been deeply embedded and institutionalized in European policymaking for the past 30 or 40 years.
Have to work this one out. So, Connor, please go ahead. Thanks.
I was just wondering, you said that it was possible to make sudden changes to the way Europe's using their fiscal rules by giving COVID as an example. But would I be right in thinking that in what you're proposing, you'd actually be introducing changes that would oppose the profits of corporations? And of course, that's a very different ask to what we saw in COVID, isn't it?
Yeah, I suppose that's an interesting way to. Sorry. Shall I respond? No, it's an interesting. It is. So on the one hand, the EU suspended the fiscal rules, allowed governments effectively to raise finance And the central bank made it possible by ultimately buying up public debt, right, in order to facilitate this investment. And the state, in turn, on the one hand, is increasing the stock of public debt, but ultimately it's owned by a public authority, the central bank. And what's going to happen to that in the future? Well, open question. Most likely will just get buried in somebody's account. So yeah, you're quite right. What's being asked here really is for the corporate sector to take a hit on profits. And I think, you know, that is an interesting kind of way for, yes, ultimately it would, certain types of profits. But what I think more specifically though, it would imply, for example, because at the moment, the European Central Bank buys ultimately the debt that's issued by whole swathes of the corporate sector. And they have done that for many years now as part of the quantitative easing program, and ultimately to reduce the interest rates on business to borrow and invest with the hope that it generates economic and employment growth and allows them to reach their inflation target. As inflation goes up, they're going to taper that off, but they've not really discriminated between whose debt they're buying. So what I'm suggesting here is that, yes, they would effectively allow carbon intensive industries to face very high interest costs. Whereas on what they wouldn't do though is they would push down interest rates, and it makes it basically make real interest rates or have negative real interest rates for clean industry. And ultimately that would be a subsidy. So the central bank would effectively be subsidizing certain firms within the market. And that's where it goes very much against the grain, because that's considered to be a big taboo in central banking, where they consider themselves to be impartial actors. But in reality, they're not impartial actors, because they've been financing and subsidizing carbon intensive firms and sectors for many, many years now. So the idea of market neutrality itself, I think, has a carbon bias, because it basically biases the market towards what ultimately exists, the current status quo. So if you want to structurally change the market and make it, you know, move towards a more eco-friendly system, you have to admit and acknowledge that there is no impartiality here. And in fairness, if you speak to central bankers privately, they'll admit that very publicly. They will admit that. The Bank of England has made very clear that they're going to introduce a more green mandate into their policy mandate. What that looks like, etc., they still hold on to the idea of market neutrality. Christina Lagarde has also kind of, so I do imagine that as time goes by and the reality of the transition and the reality that we're not getting remotely close to hitting our targets or reducing emissions, at some point, the central bank is going to have to say, okay, look, we're going to step in and we're going to finance this.
Paul, who's had his hand up on Zoom there.
No, I realize we're from the same school, so I realize we should be talking over coffee and not in the Earth Institute like this. But I'm glad to see that finally Aidan is an SDG guy. He probably doesn't even realize it now after this talk, but this is very mainstream SDG. No, not somebody's suggestion. So the first thing is there is literature on finance for sustainable development, and this new common agenda by the General Secretary is getting the G20 and intergovernmental banks and others into a room and talking about things that they could do with Aidan's paper here actually. So I think it'd be interesting to get into that dialogue actually. So there's some nice points. So the two big things I have in my mind when I'm listening to the talk, the first one is, so I did a bit on the political economy of transition, you know, from in the Soviet Union to where it is now. But there's no doubt these type of arguments about politically acceptable pathways, protecting democracy, taking into account the social environmental issues, there is an implicit assumption that your politics can deliver that. So I think there's a good bit of work there that we would actually have legislators who aren't captured by corporates, who actually are interested in a 20, 30-year plan and are interested. So in theory, you are picking that there should be people in government, you know, who could do this, you know what I mean? And I agree with you. So there's a whole thing there. Anyway, that's good. And then the other thing I think might be helpful on the Keynesian side, right? So in Keynesian economics, this is just my background in economics. In Keynesian economics, you know, you're quite right, fiscally induced demand, you're quite right to emphasize that. But in general, it's more about demand side policy. So aggregate demand in macroeconomics is C plus I plus G, right? Yeah. And I think it might be useful to decompose this, right? Because people are getting confused, right? So consumption is more about what people buy in terms of goods and services. And we expect companies to produce those goods and services in a way, the products that we buy, not all of them, right? And then you have government spending, which is obviously the public services like health. Now you could debate, but it's health. But the one you're picking on is I, which is investment, right? Which is the investment to the capital programs, right? So I'm very taken with that, a kind of a trigger for these transformations is to actually, think about where you're getting the capital program. So it's a little bit going back to Whittaker. Like, what is the capital program, and how are you financing that, and how are you going to green that, and how does it go over? And I think I think that's great, but it could be useful, right? Because a lot of equity funds are used for products and services, and there's ways to deal with that, with ESG and with consumer information. There's ways to deal with that. There's ways to deal with government spending in terms of procurement projects, how to green them, etc. But I like the way you're focusing in, which is original. It's important that you're focusing on the investment program and the capital program, and I think, and that is a big component of Keynesian economics that's kind of not really focused on, and that's what I like, right? And then the other brilliant idea really is that the discussions in the Finance for Sustainable Development have obviously brought the World Bank and IMF and certain equity funds and pension funds into the room, and I think you're quite right that they suggest that, if you like, greening is like a secondary objective. Like, so for example, they do country reports now. This is a big victory that we had. Country reports, the IMF do anyway, not just like they lend to us as well, but any potential lenders or lenders. And they said that in your tax and spend to balance your books and do your repayments, the primary targets that you talked about, that there is ways of tax and spending that's greener, that's better. So as a secondary objective, you can tidy things up and not to be causing too much harm to the environment or to society in the way you tax and spend, but meet your fiscal targets, etc. And of course, what you're suggesting, it's not radical at all, but it would be radical for them, is that no, your net carbon has to be your gold star. That is your binding constraint. Not your debt dynamics, not your fiscal deficits per se. But you have to kind of bring it up in order of importance, in a sense, to a primary target. And then it's very radical on the central, the Germans and the European Central Bank, that they, in their interest rate setting, it's not just about price stability, the Phillips curve thing that they would be into, which again, you would put a higher order sort of constraint on the way you'd release money. So money for green finance, you would be more tolerant of interest rates and inflation, etc. So I think that's quite, that's different. So I think I'd encourage you to write up the paper and certainly focus in on those policy entry points, if you like, into those. So in a way, what you're assessing is very simple, but it is quite dramatically radical in some ways. Yeah.
Shall I respond, Taz, or do you want?
It was more of a commentary I was giving.
Yeah, if there's a response there, by all means.
Yeah, no, just because they're very helpful, Paul. We might have a chat about this ourselves. I think just to pick up on your first point, it is true. This assumes a lot of state capacity. And what does that look like is another research question that needs to be probed in greater detail. Different countries have different levels of state capacity. And, I think reasonably a lot of people would question, are you suggesting somehow that these politicians in the Dáil are going to be directly involved in this? And that's not exactly, there is a technocratic dimension, rather it's public technocracy, where you are held accountable for it, but there is a lot to be said in that. And just on your final point, just to say, I think that is true. It seems to me, and just from conversations and many years now at this stage, that what's really lacking at the EU level and in the conversation about reforming the EU's fiscal rules, etc. So what's the objective? What's the actual policy target? What is the role of fiscal policy in society? Is it simply just to follow a set of arbitrary rules that were designed in the early 90s, 30 years ago, before the radical restructuring of monetary policy and all that's happened since then? Is it not reasonable to expect that we have this massive climate emergency and policy targets ought to be focused on that, and running a deficit in order to make the investments that improve the future productivity economy to deal with that transition is actually something very socially welcome? Because at the moment, the assumption is, well, no, a deficit is bad, a surplus is good, but why? And if you push policymakers, particularly German politicians, they don't have an answer to that other than to say, well, that's the rule. It's like, okay, what's the point of it though? So it seems to me that restructuring and focusing debate and generating a new narrative ultimately about the policy target is a crucial part of this process.
So, so we've a lot of questions, and there's another question on the floor here as well. I would say if people had timetables to be leaving at 11:30, feel free to do so. But I propose that we carry on for a few more minutes if you're still
sure, yeah, no problem.
There's a lot of interest here, so yeah, don't be shy to walk away if you've got to get somewhere else. But would you like to ask your question?
I think one of the last points that was mentioned is the impact of COVID, and that would have conditioned people towards this radical view of changing this thing. But we are still in the middle of only 2 years we are there. We still don't know what's the impact of COVID. For example, what we see right now with the rising living cost is that maybe the food industry will become even more pulverized. So I mean, this talk has mostly been about scaling, building renewable at such a scale that a capital investment is justified. But I mean, my only comment was that the impact of COVID is yet not seen. It might be again 5 to 10 years before we see the impact.
Yeah, that's...
Aidan, if you want to go ahead.
Okay, yeah. So no, yeah, excellent comment. I mean, I'm always a bit reluctant to say we have COVID behind us. Clearly not. But if there's a kind of a critique of what I've been saying would be, oh, hold on a second now. We've had COVID, you're quite right. And public authorities, even though nobody's explicitly saying it, monetary and fiscal policy has been working more closely together to achieve certain outcomes in terms of tackling a public health problem. But the impact has been inflation. And therefore, what you're suggesting here, Aidan, is that, you know, the state central bank should be working more closely together to develop a new kind of enterprise policy to kind of make the green transition, etc. Is that not likely to push up inflation? And the reality is one has to admit that it is very possible that these type of actions will actually increase prices. And it's related to various things that we've been speaking about in the past. However, I think it's at that point where it comes back to Taz's question on the just transition. Energy costs are going to go up, and in many ways they have to go up. And I find it interesting that no government, no politician is being explicit and honest about that. And you see it right at the moment. Europe's complete strategic dependence on Russian gas, 40% coming into the EU, as high as 55% as key states such as Germany. You know, this kind of dependence on fossil fuels and structurally moving away from that is going to be expensive. Energy costs are going to go up. And therefore, it is inevitably going to feed into the consumer price index. And therefore, measuring it that way means that inflation goes up. But that's not cost of living, because it's very possible for governments to intervene, not to bring down inflation, but to make the investments to make cost of living more affordable. And that, of course, means about reducing energy demand, making people less reliant on their car, making people less reliant on having the heating on 24/7 to get even close to a relatively warm room. So those are the type of structural investments that ultimately bring down cost of living at the same time while energy prices go up. But the classic economics, if there were economists in the room here, I would imagine that that's the critique that they would level at what I'm saying here, is that the risk, the trade-off is higher inflation. But then you get into a debate on what is the trade-off between price stability in key sectors such as energy versus ultimately the climate emergency. What is your key priority? And we can have a public debate, and that can only be decided by democratic deliberation. There's no technical solution to that trade-off. It's ultimately a political one.
Thanks. One of the first question that was asked, or the second question that was asked in the chat was whether this kind of approach had been taken already, kind of started to be taken in another state outside Europe. And have you got a?
Yeah, I mean, so you know, one could reasonably argue that China, right, has moved down this particular path. I think, you know, if you look at the investments that China has made in kind of renewable energies, it's clearly outstripping what's happening in the West. And I think the Chinese state, and, you know, I have quipped and, you know, partially joked about this in various, I have a column in the Business Post that whereas at the moment we have Gazprom, a Russian state-backed Kremlin company advertising, although the contract has been cancelled this week with the Europe's largest football competition, the Champions League, maybe in a few years, those advertisers are going to come from Chinese-backed renewable energy companies, because Europe is just not at the level of investment that's necessary to even remotely compete with these authoritarian states. And, you know, China is an authoritarian state, and it isn't a better position to make these type of investments on behalf of the state. And that's a real problem that I think for the West. And therefore, for me, this is even more of a reason why we need to give up ultimately our kind of dare say liberal obsession with these kind of rules-based fiscal policy instruments, and accept that actually the role of the state here, the public sector, is key in order building up state capacity in those renewable energy companies that are ultimately housed and held within our borders to give us energy security, and ultimately to be overseen by democratic regimes. That to me is crucial here. But one could also argue that the United States is clearly moving much faster ahead. I mean, Joe Biden's plan, his jobs plan amounts to roughly 2 trillion in investments, and it's quite clear that he sees those investments being in kind of green intensive industries. And you know, everybody will probably know he's never shy of highlighting that solar technicians are the fastest growing occupation in the United States of America, and that there are good skilled working class jobs to be made from these type of investments. And I think that's clever, because that generates an important political narrative and story that allows him to generate more popular support for what is ultimately an existential transition.
So we might just take one more of the questions from the chat, because otherwise we can
Sure.
obviously talk all day about this. It's really fascinating stuff. So thanks very much. And the second question, the next question in the chat was from Stephen Donahue about whether a similar logical framework could be brought to bear on the biodiversity crisis. And I have a particular interest in that side of things. I think it's less in the public eye in a way. Climate has got some real impetus behind it. But would you see similar kind of approaches potentially being taken by biodiversity, given there's a similar argument to be made for how important it is to our sort of being?
Oh, yes, absolutely. And everybody here will know the detailed science on this in terms of just how equal a challenge it is. And I suppose if we end up in a situation whereby these conversations shift to, well, we have this green industrial policy, we have this monetary financing and public sector channels, we have these key policy targets, the aim ultimately is net zero, and our instruments are designed to reach that target, and we built up state capacity, then it's a question of detail, then it's a question of specifics. And of course, biodiversity is key and a part of that. And I think conversely, the risk really of allowing big corporate finance to lead the charge is that if they're not that bothered about the just transition, they're most certainly not that concerned about things like biodiversity. And you see that there's so many different examples. People are probably aware of the oil company, I think, is it in Congo, who ultimately they want to extract more oil, and as a trade-off, they're going to create a new carbon sink. And to do that, they're basically going to tear up large parts of the savanna and build trees for timber production to commercialize timber. That totally goes against, any reasonable, alignment of these goals, and recognizing, how the centrality of biodiversity in this process is key, but that's the profit motive.
Very much, yes. I mean, the detail is there. If the message can get in, if the framework is established, you could start directing things towards a proper consideration of biodiversity as well.
Absolutely.
Okay, fantastic. So listen, I think we better wrap up the question and answer at that point. I've really enjoyed the session. Thanks ever so much, Aidan. Really fascinating insights there. And thanks everyone for joining us, both in the room and via Zoom. And I look forward to the next one. Thanks very much.
Bye. Thank you. Bye-bye.